What's going on, guys? Alex here. And this wonderful evening, we're going to be taking a look at the CARES Act, and specifically the provisions of the CARES Act which relate to small businesses. Now, I'm not crazy about the term small business, okay? Because everybody's small business is big to them, right? A lot of my clients are reaching out to me. They have a lot of questions, and it's not that they have 18 different businesses, 20 different businesses that they run and own. It's usually one or two. So it's important in terms of putting food on the table, and with everything that's going on right now, that's become increasingly more difficult. Of course, you got this coronavirus thing that's slowing down the economy pretty significantly. And of course, there was the CARES Act, which was recently enacted and put out there, 880 beautiful pages of legislation, which everybody's trying to dig through and understand and wrap their minds around. Specifically, two areas of the CARES Act are of particular interest to small businesses. Now, one of those is the Paycheck Protection Program, which I'm probably going to refer to as PPP. And I'm going to try not to make any jokes regarding that. We'll see how that goes. And the other portion of that is Economic Injury Disaster Loans, or EIDL. All right. And those are really the two main areas that I think would be applicable for small businesses and helpful for your pizza shop, for your service business, for your attorney that works just as a lawyer by himself, your graphic designer, makeup artist, what have you. So more of those traditional small businesses, even though that term kind of drives me nuts. We're going to separate this video into three phases. Okay. The first phase is going to be a general overview. First, we're going to understand what we're even talking about, because the way things are playing out and how everything is going, it's important to frame this whole thing. Where did this even come from? What are we discussing? So we're going to get a very general overview, just get a lay of the land and understand what we're even referring to from the very beginning. I'll show you where it comes from. It's not going to turn into a legal lecture, but we're just going to take a brief look at where this language is being generated so you can understand how it's filtering through the media, filtering through what business owners are seeing and hearing, and so forth. And once we get an idea of the general framework, the goal is going to be to get into the details, get into the weeds, see what these provisions actually mean for your everyday business. All right, we don't want to talk in generalities. We don't want to talk about, well, this is a loan, this is a grant, and that's that. I want to get into the meat of it. And that's going to be the goal with the second phase of this. We're really going to get into some details here, and we're going to try to put together an apples-to-apples comparison of what these provisions mean, being the PPP on one side and the EIDL on the other, and how this all plays out to your actual real-life, everyday business. Now, with that said, well, let's talk about part 3 first before we get into that. Part 3, I'm going to discuss the implementation of this thing, which is how things are actually playing out on the ground. And we're going to take a look at some Reddit posts, which admittedly we need to take with a big grain of salt, but there is some information out there. And we're going to discuss how this all kind of played out and came together, because as with anything that is done on such a large scale, it's always interesting to see the mechanics as it works its way through the government. The banks get involved. Everybody starts taking their little piece. And what we're going to see is that this thing actually changed very recently. There was some guidance put out in the middle of the night, apparently, whereby if you read about it on April 1st, you may have outdated information as to what things look like now. So it's kind of interesting how it played out. I'll throw some of my opinions onto this whole situation at the end there. I know a lot of people don't care about what I have to say about it, but I'm going to throw that in there in case you want to see it. So those are the three sections. We're going to do the general overview. We're going to look at the details, get into the meat of this thing, understand it more, and then we're going to see how this is actually playing out in real life. It's pretty interesting. And a few things I want to mention before we get into it. First of all, I'm not an expert at this. All right. Anybody that tells you that they got their mind wrapped around these provisions, I think is crazy right now, because the ink is not even dry. All right. Aside from that, things are still changing, because videos that you're watching about this from 2 or 3 days ago may be completely outdated. So it's important to make sure you're working with the most current information. So we're going to learn this together. I set up a handy-dandy spreadsheet here. Let me show you this. All right, and it has a few categories. We're going to be taking a look at the $10,000 EIDL grant. We'll get into what all this means. Don't worry about it right now. Then we're going to take a look at the economic injury disaster loan provisions, which these are pretty much related here. So you got the EIDL. Just keep that in mind as far as kind of one side of this. And then the Paycheck Protection loans or the Paycheck Protection Program, whatever you want. Let's change it because now it's driving me nuts. All right. So those are basically the two areas we're going to be taking a close look at. And we're going to take notes as we go. So we eventually want to have pretty much an apples-to-apples understanding of what these provisions are, what they mean, advantages, disadvantages, differences. I want to know. And we're going to do this live because I haven't done this yet. A lot of my clients are asking questions. I don't have answers. So I thought, hey, why not learn about it and bring you guys in on the process? So we're going to do this together as a team. What better way to spend Friday night, right? Okay. So let's get out of this for a second. So we're going to be learning this together. That's number one. Number two, none of this is legal advice. None of this is tax advice. So don't watch a few minutes of the video, run out and act on the information. That's not the goal here. The goal is to learn. It's to better understand. But before you act on anything that is presented in this video, consult with your financial professionals. Consult with your attorneys because they know your situation best and they can advise you accordingly. Third, I'm not making any recommendations here. So I'm not telling you to take a loan. I'm not telling you not to take a loan. We're simply learning about this together, piecing it step by step so that we can understand and be conversant about it and have a much better cohesiveness when we think about this in terms of our own businesses. All right, those are going to be the goals. Those are the things I want to outline. And now I'm going to stop stalling. All righty, so from the very beginning, what are we even talking about? CARES Act, EIDL, where's Alex even coming from with this? Great questions. Now, this all began, so to speak, with the CARES Act. And you see it on the screen right there. And the one thing that I don't understand is why this is an act to amend the Internal Revenue Code of 1986 to repeal the excise tax on high-cost employer-sponsored health coverage. I don't know what that's doing there. It's kind of weird. But aside from that, we see that this act may be cited as the Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act. And you got to love it how our politicians, they spend a lot of time making sure that their bills contain a nice, convenient acronym. If they spent that much effort doing other things, I think we'll be... never mind that. That's a different conversation. That's probably part 3. We'll save that. Anyway, where is this all coming from? This is an 880-page bill. There's a lot of stuff here. And I think an important thing for business owners is to zero in exactly on where some of this language is coming from, again, to get a much better understanding of how this is making its way through the media, where the information is originating from. So a few things that you want to keep in mind here. So one of them is Section 1102, Paycheck Protection Program. This is big, all right? And we click into that, and let me throw this link in the chat for you guys so you can follow along. And feel free to ask any questions in the chat. I'll try to answer them as best as I can, given the information. I might have to research it and come back to you, but I'll certainly try. So looking at this Paycheck Protection Program, there are a few things here to keep in mind. So with regard to the PPP and the EIDL, it's crucial to know that they're pretty much separate loan programs with the same goal, the goal being helping businesses, but all of the other details for the most part are different, okay? So it's important to understand the differences because you may want to apply for one, you may want to apply for the other, you may want to apply for both or neither. So with that, the differences become extremely important. So a few things in the language of the bill. Again, this is not going to be legal review by any means, so we're going to be out of this legalese very quickly. But I did want to highlight some points here. So firstly, let's take a look at some large numbers, okay? And this is the $349 billion amount that you're going to see in the media pretty often, all right? So this is going to be quoted with regard to the Paycheck Protection Program. This is where that's coming from. So if we scroll up here, we see that we're in section 1102, and little ways down, we see that there's $349 billion being allocated to it. So when you hear news reports, when you see different articles that are referencing that $349 billion has been put out there to help small businesses, this is what they're talking about. All right, this specifically the PPP program, Paycheck Protection Program. All right, this is the big kahuna. This is the big dollar value that can be applicable to small businesses as compared to the EIDL, which we'll take a look at in a second. So, long story short, for now, $349 billion, Paycheck Protection Program. So let's actually jot that down in our notes. Now, these notes are going to slow the video down a bit, but I think it's going to be important once we're all done here to take a look at this and see who really benefits, who doesn't benefit. Let's really understand this thing, right? All right, so total amount allocated. Let's call it that. So we're talking about the PPP program, and it is $349 billion. Okay. Pretty significant. So let's keep looking. On the other side of things, there's the Economic Injury Disaster Loan, EIDL. That's in good old section 1110. Let me show you how to get there. So if you go back to the top of the page here, if you go to section 1110, you see that we have emergency EIDL grants. Now, I know it says grants. Let's just click it. We'll get into more details. So this section has to do with the other loan provisions that are available to small businesses. So this is not exactly a PPP. This is the EIDL area. And the important amount here that we need to take into account is, first of all, $10,000 in terms of the emergency grant. Now, I already covered this in a different video, but as part of the EIDL side of things, there is this emergency grant, which I put in the spreadsheet right here, and it's up to, let's edit this, okay, up to $10,000. Now, the total amount that it may come to, we're going to get to that in a little bit, but for now, we're going to assume that it's up to $10,000 given the information. And the other amount that I wanted to touch on is this right here. $10 billion. All right. And that is the total amount of appropriations that have been allocated to this particular program. So amount, I like this better. Total amount appropriated. Okay. So for this program, the EIDL, it's $10 billion. Not potatoes. So that technically includes this as well. So these are together. Let's sort of link them. All right. So those share the same $10 billion appropriation amount. You got the $349 billion amount here. So obviously a lot bigger on the PPP side of things. But that's how the bill is structured. So when you're referring to $10 billion worth of aid, that's what they're talking about there, the economic injury disaster loans, the $349 billion Paycheck Protection Program. All right, so let's go back to the language for a second. And I did want to touch on a few other items here. And specifically, if we go back to the Paycheck Protection Program, again, PPP, let's look at years. Let's see what it has to say about that. So if we're at the top of this thing. All right. So we see here that there is a maximum maturity of 10 years from the date on which the borrower applies for loan forgiveness under that section. Okay, so we're talking about, let's see here, Paycheck Protection Program. All right, so what we're seeing is these loans can be up to 10 years. All right, and maximum maturity. So let's enter that info. Okay, so we're talking about 10 years. Again, I want to make sure we're accurate. Up to 10 years. All right. And in terms of the interest rate, what kind of interest rates might we be looking at? Over here, we see that a covered loan shall bear an interest rate not to exceed 4%. Okay. So this is for the PPP. Let's keep filling this out. All right. So now that we have that figured out, this gives us a little bit of detail. Now, let's talk about the other side of things for a second here and see if we can dig up any information on the EIDL side on what all this looks like. Now, we go into this section 1110, and this talks about the emergency grant. We'll get back to that in a second. Let's see if there is anything about interest rates. And doesn't seem to be anything separate here about interest rates that I could see at this particular moment. So we're going to leave that for now. We're going to come back to it. We do want to figure out what that interest rate is. Let's see if there's anything else here about the $10,000 grant or up to $10,000 grant, and then we'll move this party along. The interesting thing is that in terms of repayment with this grant of up to $10,000, an applicant should not be required to repay any amounts of an advance provided under the subsection, even if subsequently denied, have trouble there, a loan under Section 7B2 of the Small Business Act. Now, it's interesting because this EIDL section, even though it refers to grants, also allows for credit elsewhere, right? So with respect to a loan made under Section 7B2, the administrator shall waive. So essentially, the way it's structured, and I'm not an expert on this, but my understanding is that you have this bill, and there's a lot of language here to begin with, but what it's doing is extending branches to the Small Business Association, the SBA loan provisions. Specifically, it looks like 7A and 7B. And that, from my understanding, is where a lot of these rules are coming from, in that they can make loans for these types of businesses, those types of businesses. So there's a lot of language in here, but it's also reaching out to the SBA side of things and using those provisions as well. And we see here that it refers to this Small Business Act, so a lot of the language is going to come out of that. But let's see some more important nuggets that we could take out of here. Verification for this emergency grant. Before dispersing amounts under this subsection, the administrator shall verify that the applicant is an eligible entity by accepting a self-certification from the applicant under penalty of perjury. Okay, so let's write that down. So that's important, because if you don't have to provide financial statements and you don't have to provide projections and business plans and things like that, that's makes it a lot easier. So we're talking about the emergency grant and the fact that in terms of the verification, it's self-certification, which makes it generally a lot easier to deal with. Okay, learning a lot. All right, so we have the total loan amount. Let's add that in. Very important. Maximum maturity term, let's call it that. So the maximum loan / grant amount, let's call it that. Now, under this up to 10,000, we have 10,000. Makes sense. Now, let's see what else we can take out of the language of the bill itself. Now, the interesting thing is, an applicant shall not be required to repay any of the amounts of an advance provided under this code section, even if subsequently denied a loan under Section 7B of the Small Business Act, 7B2. So how are you required to use these funds? Let's take a look. There's a section called aptly use of funds. An advance provided under the subsection may be used to address any allowable purpose for a loan made under Section 7B2 of the Small Business Act, including providing paid sick leave to employees unable to work due to the direct effect of COVID-19, maintaining payroll to retain employees throughout business disruptions or substantial slowdowns, meeting increased costs to obtain materials unavailable from the applicant's original source due to interrupted supply chains, making rent or mortgage payments, and repaying obligations that cannot be met due to revenue losses. So all this really important. And I think I just might jot down this goodness for later. All right, so let's throw that into the spreadsheet. Hopefully it doesn't crowd it up too much. All right. Right, we might have to move that section down a little bit later on, but for now, we're going to keep it. Now, let's just do this for now. But that's important information that we'll get to later. All right, so as we keep reading, we see that in terms of repayment, there is the provision that if you use it for the uses shown here, the idea is you don't have to repay this thing. So it's not so much a loan in that respect. It becomes more of a grant, which explains the entire title of this whole section of the bill. So let's put that in our handy-dandy, I dare say beautiful spreadsheet. Let's call this forgiveness. And in this case, let's make sure we spell it right. You know how that goes. All right. Good old spell check. Can't live without it. All right, so forgiveness, yes, definitely is applicable here if you spend it for the right reasons. So we're going to move that all the way up here. All right. It's a good baseline for us. So now we know a little bit about the grant itself. We have a lot of areas to better understand here, of course. So we'll make sure to fill in the gaps as we go. But so far, we don't know the maximum maturity of this thing. And the question is, if you don't spend it on these purposes, so if you get this grant and you don't spend it on any of this, what happens? Does it convert to a loan? What are the terms of that loan? Remains a question. I don't know yet. I have to find out. It may be something that is delineated in the Small Business Act, in which case we'd have to take a look at that, but we're not going to go there for now. All right. Now, this is the basic layout. Going back to the Excel document, we have the grant of up to $10,000, which has some elements of forgiveness associated with it if used for the right purposes. It's based on self-certification, so there shouldn't be a lot of financial statements and documentation that needs to be provided. And that is what we know for now. And aside from that, there are those loans that are available. There's $10 billion set aside for that for EIDL. And then the Paycheck Protection Program is that big kahuna. So now we should be a little bit more conversant when we look at articles, when we look at other sources of information as to how to navigate all of this. So I'm going to try not to say so much, but you know how that goes. Hopefully it'll become a drinking game one day where every time you hear me say so, take a shot. But that's a different story. Now, as far as the SBA portion of things. Obviously, that's language all in and of itself. You have disaster loans. This is that section 7B specifically. Has to do with disaster loans, and obviously you can see there's language here for days and days. So this is disaster loans. We have B in terms of the Small Business Act. Let's see. Do we have an A? I'm curious. So this is section A, and I'm sure that they would have a section 7A as well. So we have a B, but I don't see the A, or maybe that's at the very beginning. Okay, maybe this is this. So they have small businesses, loans to small business concerns, allowable purposes, and so forth. And then they have another one available there. So anyway, the point is the Small Business Act is tied to this new bill, and a lot of the provisions are going to piggyback off of that Small Business Act. All right. Now, looking at the reports in the news, we've got an article here from Vox, which honestly I don't think is a great source, but I do want to show you how this is shown in media resources that you may come across. So if you're reading this, you can digest it that much more easily. And specifically, we see here that there's the Paycheck Protection Program, which enables organizations to obtain up to $10 million in loans that are 100% forgivable if they do not lay off any employees or if they rehire employees they've already laid off. All right, so let's jot down some notes. And we're talking about $10 million being the limit. Okay, and this is in the wrong category. We're talking about Paycheck Protection Program. And forgiveness, yes. Subject to conditions, of course, but it is available there. Let's call it maybe. Because if you meet the requirements, then it may be forgivable, but not necessarily. Okay. Now, the second provision is the Economic Injury Disaster Loan Program, EIDL, which includes a $10,000 grant. See, this is where they have to be careful. This is why a lot of my business owner clients, they call me and tell me I'm reading different things in different places. Here's an example. Includes a $10,000 grant. Let's look at the bill. We already know that when we talk about the $10,000, the all-important words are going to be difficult to find now, but shall not be more than 10,000. It's up to 10,000. This is where, with the words, we have to be careful. I'll even put it up. Well, we're talking about maximums already. So 10,000, it's the maximum. It can be less than that, substantially less, possibly. All right. This is why I said in the beginning, Vox isn't a great source. I just wanted to show you how the news media is reporting these things, so that once you read it, you can have a more discerning eye and know that, hey, it's not 10,000, it's up to 10,000, which they do not need to pay back. Again, I said in the very beginning, I don't like Vox. We know that it's not that they don't have to pay it back. It's that, going back to the bill, if they, let's go to the repayment provision. An applicant shall not be required to repay any amounts of an advance provided on this subsection, even if subsequently denied a loan. But what it seems to say here is you have to use it for these specific purposes. Now let's just read here a little bit more. Okay, so it's not referring to it specifically, but it is laying out the use of funds. An advance provided under this subsection may be used to address any allowable purpose for a loan, including. So, again, it refers to the Small Business Act, but it's not just free forgiveness. You need to use it for appropriate items to help your business Can't just buy sushi with it. Even though I haven't had sushi in a while, this is one of those things you start to miss. Regardless, let's go back to this. I think I'm a little hungry right now. Back to the article. The rest of the EIDL loan, which caps out at $2 million, another nugget there. Again, I'm going to very much fact check all of this. But as we're going through, let's pick up little things here and there. Up to $2 million EIDL loan. Okay. Is not forgivable, but can be more flexible than PPP and the type of expenses it covers. All right. Now, I don't know if there's much else of value in this particular article. Again, this is just something you might come across when you're reading this stuff. Let's just verify that we understand. It says the Paycheck Protection Program, roughly $349 billion. All right. Right there. Is dedicated to establishing the Paycheck Protection Program. Got it. All right. Now, it does mention that it has to do with 8 weeks of payroll, so we're going to get into that as well, along with some utility and rent costs. We're going to delve. There's going to be a delving. But right now, let's just leave it kind of general. Another important fact, businesses are able to request 2.5 times their average monthly payroll costs for this loan. Again, I'm not crazy about the wording here because they're saying 2.5, maybe up to 2.5. So let's be careful there with the language. But this is just a general article you may come across. And I think that's about it for this article. Let's move on. And one interesting thing is that as we're going through here, this program seems to be changing and morphing right before our eyes. And specifically, this is an article that is a few days old. This was updated on April 1st, 2020. And April Fool's Day. Maybe that has something to do with it. But this is from the Philadelphia Business Journal. And they're talking about SBA loans, answers on interest rates, application process, and CARES Act from Mid-Atlantic Boss. Sounds like a mafia thing, but this is actually an interview with the acting director for the U.S. Small Business Administration's Mid-Atlantic region. Steve, that's a rough name. We're gonna call him Bulger, okay? Let's be mature about this, okay? I'm gonna call him Mr. Bulger or Steve, and we're gonna go on. So he's going through this interview, and one important thing that you will catch here. First of all, let's take a look before we get into the big controversy of this whole thing. Let's understand some of these other references to the bill. Now, it says here the stimulus package specifically allots $10 billion for disaster loans. We talked about EIDL. And $350 billion. We all know, you and I both know it's $349 billion, okay? But what is a billion between friends? I always say. So, $350 billion, it's an unfathomable number. I mean, it's such a big number. It's crazy. For paycheck protection loans to help small businesses. Here's how each works. Now we get some idea of the interest rates, but more on that later. Okay, so EIDL offer disaster assistance loans offer disaster assistance of up to $2 million. Let's just verify as we're going along. EIDL, okay, maximum loan, $2 million. We're good, okay, so far. To replace short-term lost revenue with interest rates of 3.75% for small businesses and 2.75% for nonprofits. Small businesses are eligible for a $10,000 advance. Again, you have to word that carefully. There are a lot of business owners that are expecting $10,000 where we already know it's up to. Could be $5, could be $100. Who knows? But this is why I wanted to show you how this is being presented in the media and explain why business owners are so confused, because there's a lot of misinformation. This is very new, but I'm not knocking this. I'm just saying that you got to be careful what you read, and that's why we're doing our notes here so we can keep track of any inconsistencies that we come across. All right, and this is driving me nuts here. So what we're going to do is just fix that. All right. I feel good now. My OCD was acting up. Let's take these interest rates into account. So we're talking about the economic disaster loans. Okay. All right. So 3.75 for small businesses and 2.75 for non-profits. All right. I mean, it's not the smallest loan interest rate ever, but at the same time, it's better than going to a credit card or reverting to one of these horrific payday lenders. I mean, that should never even be an option. But there we are. Now, small businesses are eligible for $10,000. We know it's up to. You know what? I'm going to change this. So up to $10,000 because I don't want to perpetuate the misinformation. We're going to also edit this. We want to make sure that it's all about the facts. You know, just the facts. Now, if you're still sticking around with me with this video, drop a like, drop a share, just hit those buttons down there. I mean, I don't even know what they are. Alrighty, so we're building this whole thing up. It's looking good. We'll get right back to the action, folks. Just give me a second, make this look nice and presentable. Non-profits. You can't forget the non-profits. All right. All right. Now, the Paycheck Protection Program offers loans of up to $10 million. Let's make sure we have that. Up to $10 million. Okay. See how things are aligning a little bit more now? At an interest rate of 0.5% through SBA-approved lenders, where the proceeds are used to pay employees and so on and so forth. Now, let's add that as well, that little detail. I don't know if you caught it, but so how do you apply for these loans? It's a great question. So the Paycheck Protection loans, SBA-approved lenders, you need to go through the banks for that. All right, so let's see this. Now, that could be a good thing, could be a bad thing. We're going to touch on that in part 3. Stick around, okay? I structured this to have some cliffhangers on it, all right? But anyway, SBA-approved lenders for the PPP, okay? And we're going to keep filling this out. This looks good. All right. So that gives us some more insight into this whole thing. But this is the most important detail here, and this is kind of little foreshadowing, all right? Interest rate of 0.5%. Let's fill that in. Now, we're getting different information because in the bill itself, we saw that it was going to be up to 4%. So technically it said not more than. But now we're seeing some different language in that it's essentially saying that it's 0.5%. Okay? I'm going to highlight this in red because I'm going to come back to that little ditty. Okay. Let's take a little bit. And guys, I'm double fisting it today, all right? This is middle of busy season. Okay, so we got the tea right here, the black tea. This is my go-to. I love it. And we got the coffee right here. If you ever want to find out whether it's busy season, you'll know it if I have coffee. I hate coffee. I can't stand it. This is mostly almond milk with a splash of coffee on top of it, and that's about all I can stand there. So we're going to take a little swig. Keep the party going. Now, what I noticed is a lot of people came onto the stream, and then some people left. Where are you going? We're on lockdown. What's more fun than this? Nothing. All right. So the rest of this article, I didn't really see that it has too much applicable to it. So we're going to move on. Now, again, this was written in April 1st, 2020. Good old April Fool's Day. Let's look at an article that was written more recently about this stimulus situation. Treasury makes, and this is CNBC, Treasury makes coronavirus loan terms less favorable for small businesses. You'd think in this time, with what everybody's going through, they'd want to make it as favorable as possible. But the Treasury makes it less so. How is that? Now, we read that the Paycheck Protection Program loans have a higher interest rate and shorter payback period for small businesses than originally stipulated. Okay? And the $349 billion forgivable loan program is a core component of the $2 trillion package. That we already know. So, skipping some of this that we are already familiar with, it says here, in initial guidance, the Treasury Department had said banks would charge a 0.5% fixed interest rate and that a loan's unforgiven portion could be repaid over 10 years. Let's look at our spreadsheet. Let's make sure that's accurate. So we're talking about 0.5% up to 10 years. Okay? However, loans now carry a higher interest rate of 1% and come due in a much shorter period, 2 years, than originally stipulated, according to Treasury guidance released Thursday. Isn't that interesting? Isn't that fascinating that we're reading an article? First of all, this bill barely has dry ink on it. We're reading an article from April 1st that's talking about 0.5% as the rate. And now all of a sudden, this article came out on April 3rd, 2020. Now the terms are less favorable. All of a sudden. Fascinating. And surely enough, I mean, you pull up this document that CNBC has linked, and you see here that certainly that's what it says. Talk about the Paycheck Protection Program. There's a lot of other good information here, but let's just make sure we're not going crazy. So let's just search interest rate. Okay, look at that. What is my interest rate? 1% fixed. When is my loan due? In 2 years. Now, going back to the language of the bill that has barely been passed, it had much more favorable terms. And you have to think, what happened in the last few days that has spurred these changes? Now, it might have to do with the fact that you have this element happening. You got to go through the banks. You think they may have some say in how this is all going to play out? Quite possibly. And we're going to get into that a little bit more later on. But now we have to change this. And you see how quickly these tectonic plates can adjust depending on who gets involved and who has a say. So that we have to change. Now we're talking about 1%, which is double. Again, much better than credit card interest rates and any other loans you can get, but fascinating how it all plays out. Now this up to 10 years. Now we're talking about 2 years. And is this a fixed 2 years or is this going to be a maximum? Let's take a look at that guidance again. This is the fact sheet regarding the PPP. And let me throw this link into the chat for you guys. Now, going back to the fact sheet, it's 2 years is when it's due. Can I pay my loan? Let me make this so you guys can see. It asks, can I pay my loan earlier than 2 years? Yes, there are no prepayment penalties or fees. Do I need to pledge any collateral for these loans? No, no collateral is required. Now, let's make sure we're dealing with the correct loans here. We're talking about the PPP. All right, so now we have a loan due date of up to 2 years. We know that there are no prepayment penalties. Okay. Penalties or fees. Can I pay my loan back earlier? Yes. And finally, no collateral is required. Okay. Do I need to personally guarantee this loan? No, there is no personal guarantee requirement. However, if the proceeds are used for fraudulent purposes, the U.S. government will pursue criminal charges against you. All right, they highlighted that. Let me show you guys. With 3 asterisks on each side. That's 6 total asterisks if you're adding them together. So no personal guarantee. That's another important nugget. Collateral required. Personal guarantee required. Had a business client ask me that. So let's put that in there. No. This is from the Treasury itself, so it should be reliable information. But the more we're learning about the Paycheck Protection Program, the more we're realizing we don't know about these guys. But we're learning together, guys. I'm having fun. All right, so now we're seeing that the program kind of started to change. Now we're talking about, now forget about the 0.5%. Now we're up to 1%, which is the latest info on this. Now we know that it's 2 years. It's due in 2 years, but you can prepay it. No prepayment penalties, no collateral, no personal guarantee. Let's just make sure we're tracking all that. Maximum maturity. Seems like it's 2 years, not up to 2 years. It seems like it just matures at the 2 years and you can prepay it if you want. But the term itself doesn't seem to be variable. It seems to be fixed. So fairly confident based on what I'm reading here. Okay. Now, the certification requirements are a little different here because if we remember, we have self-certification here, EIDL grant, but then there's certification here that seems to be a little bit more robust. Oh my goodness. What do I need to certify? As part of the application, you will need to certify in good faith that current economic uncertainty makes the loan necessary to support your ongoing operations. How is that not the case for any business? That's what I want to know. What business is not affected by the current economic uncertainty? And how do we define necessary in terms of this provision? Meaning that, is it possible to scrape by without this loan? And if so, doesn't qualify you for this loan? It's very strange. Again, we can go back and forth debating on the language of this, but to be honest with you, it's just a rush job that was put in place, quite frankly, and we just have to try to piece it together the best that we can. But they're saying here you have to certify that. You have to certify that funds will be used to retain workers and maintain payroll or to make mortgage, lease, and utility payments. All right. You have not and will not receive another loan under this program. You will provide to the lender documentation that verifies the number of full-time equivalent employees on payroll and the dollar amount of payroll costs, covered mortgage interest payments, covered rent payments, and utilities for the 8 weeks after getting this loan. That's a time period that is important. We're going to delve into that a little bit more. Now, it says loan forgiveness will be provided for the sum of documented payroll costs, covered mortgage payments, covered rent payments, and covered utility payments. Due to likely high subscription, it is anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. Okay, so now we're talking about loan forgiveness. Let's jot this down. And we have a little bit more details here. Forgiveness requirements. Let's take a look. If we can just copy this bad boy. Okay. I want a little bit of word wrap on that whole situation. All right. So here's a little bit more insight in terms of what is going to be necessary for the loan forgiveness. So they want the documented payroll costs, covered mortgage interest payments, covered rent payments, covered utilities, and they don't want these loans to be spent predominantly for non-payroll. They really want to avoid mass unemployment, which you don't need to be a scientist to understand that could be extremely detrimental to the economy overall. So they don't want you to spend this all on employee lunches, on supplies, on inventory. They don't want more than 25% of this spent on non-payroll costs. So that is an important parameter, and that's why it lends itself to the Paycheck Protection Program. And instead of the requirements, let's just put details here, because we don't know if how much of this is required, how much of this is subject to the parameters within the bill, but that is some detail there. So further, it says that all the information you provide in your application is true and accurate. That should be obvious. You acknowledge that the lender will calculate the eligible loan amount using the tax documents you submitted. You affirm that the tax documents are identical to those you submitted to the IRS. And you also understand, acknowledge, and agree that the lender can share the tax information with the SBA's authorized representatives. All right, so it looks like they're going to want tax information and some documentation here. It's not exactly clear on what specific documents they want. But let's see. Loan amounts will be forgiven as long as the loan proceeds are used to cover payroll costs, most mortgage, interest, rent, and utility costs over the 8-week period after the loan is made. Doesn't look like it's going to cover those principal payments, but the loan interest payments look like they may be covered. All right, so let's drop that in there. Over the 8-week period after the loan is made. Okay. Loan proceeds are used. Let's see here. Loan proceeds are used. All right. If the loan proceeds are used to cover payroll, and so forth. But they do have the stipulation that the payroll has to be the majority of it. Basically, looks like over 75%. That's going to be a threshold that comes up again. But we're learning more about this. Look, we didn't know anything. Now we're fairly knowledgeable, at least about this PPP section. All right. Let me also throw a link to this document into the chat for you. Okay. This is from the CNBC article that shows that while these terms are very friendly for businesses, they're not as friendly as they were a few days ago. And even though the bill itself provides for, not more than 4% interest rate, we saw that the maximum maturity term was up to 10 years, but then it became 2 years. So more on that later. Okay, so in terms of the interest rate, though, on the EIDL grant, if it's used for the purposes stipulated, meaning the providing paid sick leave, maintaining payroll, meeting increased costs to obtain materials, making rent or mortgage payments, and so forth, so this is the uses of the funds section here, then it sounds like those amounts will be just forgiven. But what I want to know is if those amounts are not used for those purposes, what happens? Does it turn into a loan? Interest rate is yet to be determined for that if that's what happens. But if it's just a grant, then the idea is if it's used for the right purposes, it's forgiven. And you don't have to worry about an interest rate there, so it wouldn't be applicable. Okay. Now, what else wouldn't be applicable here? Let's try to fill this in as much as possible. Maximum maturity term shouldn't be applicable. Again, if it's not a loan, there's really not a maturity term associated with it. This probably wouldn't be applicable as well. Prepayment penalties, again, if it turns into a grant, is collateral required. Same idea. Personal guarantee required. That shouldn't be the case if it's a non-loan. So it all has to do with whether it turns into some sort of loan if you don't use it for the right purpose, or do you have to repay it immediately? So that's kind of a question there. Let's link these bad boys together. All right. And this EIDL is looking kind of lonely. We're going to try to fill that in as well. So what I think happened was that the Treasury Department and the SBA were working together, and they felt that 0.5%, which can be paid over 10 years, is a beautiful thing. But let's keep in mind that they also had to go to the banks. And when the banks stepped in, sounds like they had something to say about this whole situation. Let's take a look. Let's get to that in a second. Again, cliffhangers. I got to build the suspense. But there is an article here in Forbes. Let me throw the link in. And it's called Getting Cash for Your Business Through the CARES Act. Notice it's been updated on April 3rd because they knew that new information came out. And that's to reflect the most recent SPA guidance, meaning that this is very rapidly changing. That's why you may read two different sources and they'll have different information because this is a moving target in some respects. So let's read through this and let's see if this information agrees or what new things we can learn. Now, this deals with the Economic Injury Disaster Loans, or EIDLs. And specifically, it says the SBA offers favorable terms in their EIDLs. Loans are up to $2 million. Let's check our information. Got that. The term is 30 years. Now, the question is it up to 30 years? Is it 30 years on the dot? That is probably something that's going to be spelled out on the SBA side of things more so than the actual bill, because I don't see 30 years here anywhere. So if I search for 30 years, it's just not there. But 10 years, that I'm finding in the bill. So might be on the SBA side that we would have to learn more about that, but we're not gonna go there for now. So let's just jot down that the term is 30 years. Again, I have a feeling it may be up to, but let's just put that for now. Okay, let's get back to that one because I'm not looks suspect to me. Alrighty. Now, interest rates are 3.75% for small business, and 2.75 for non-profits. All right, so we have that. Cool. All right. Interest rate. Okay. And interesting new information here. The first month's payment are deferred a full year from the date of the promissory note. The first month's payments. This doesn't make sense to me. The first month's payments. I want to read this somewhere else because I feel like there's some missing information. What is that? Just the 1 month of payments on a up to 30-year loan are deferred? That's supposed to be a big deal? It's kind of weird. We'll get back to that. Alrighty. Now, it talks again about the grants in terms of borrowers can receive $10,000 in grants and emergency cash advance that can be forgiven if spent on paid leave, maintaining payroll, increased costs due to supply chain disruption. Basically, everything that we have over here is spelled out. Okay. And it goes further to say that the $10,000 emergency cash grants are particularly interesting. As so-and-so explained, applicants can get the emergency cash even if they don't qualify for additional funds. Because lending decisions are based on self-certification and the applicant's credit score, the review process should go quickly. And CARES waives the requirement that you are unable to obtain credit elsewhere. So that's another interesting fact about the CARES Act, is that it seems to suspend a lot of the provisions which would be traditionally applicable to small business loans. And it makes it a bit easier in that you don't have to show that you couldn't get credit elsewhere. That's friendly towards business owners. It's a friendly provision. That means you can apply even if you already have a credit line. Okay? It's kind of vague how it's worded, but it's there. And now that we have the credit score in here as well, I want to throw that into verification. Maybe that'll affect your prospect of receiving this. And one thing that I'm still not seeing is what is going to be the calculation for determining what you get up to the $10,000. That has been completely nebulous. I haven't seen any guidance on what that might look like overall. So that's a big question. All right. And in terms of applying for this, let's see. Now, basically, I think you can just go directly, and if you just search COVID-19 SBA, loan application, this should get you to the link. Let's take a look. Loan assistance. Click here to learn about it. Paycheck Protection Program. Now I have everything zoomed in, and I'm using a different browser here, but let's see if we can pull this link up. This should be a pretty straightforward way to get there. Bear with me here. So, apply EIDL SBA. Let's try that. All right, so here is the application. I'm going to throw this into the chat for you guys. And as we can see, if we are looking for the EIDL side of things, essentially you're applying directly through the SBA website itself. So let's note that in our information. SBA website. Direct. And that applies to these loans as well. So as you're seeing right here, these loans are fairly straightforward in that you just go to the website, you apply for them, or this loan and this grant, I should say. And here you're dealing with banks. All right, let's go back now that we have that settled. Talks about some more details here. And again, let's verify the information that we have. And the Paycheck Protection Program loan guarantee offered to businesses with fewer than 500 employees, select types of businesses with fewer than 1,500 employees, nonprofits. A lot of my clients have much fewer than 500 employees, so we'll keep that into account. I'm probably not going to note that separately in the spreadsheet. So, as self-employed, sole proprietors, freelance, and gig economy workers are also eligible to apply, but you have to have been in operation before February 15th, 2020. All right, so they don't want just everybody waking up and saying, hey, you know what, I'm a self-employed business owner. That's what I am, and suddenly apply for this. Loans are given up to a maximum of the lesser of $10 million. Now we're getting more details. Or 2.5 times the average monthly payroll costs, including wages for employees making under $100,000, as well as expenses for paid sick leave, health care, and other benefits during the 1-year period before the date on which the loan is made. Okay, so let's note that. That's new information that we're gathering here. Let's put that into our stockpile. All right, so this is the PPP, up to $10 million. Okay. All right. So that definitely helps round out what it might look like. So 2.5 times the average monthly payroll costs, including wages for employees making under $100,000. Now, the question then becomes, if they make $101,000, do they not count, or do we just count the first 100,000? It's a good question. As well as expenses for paid sick leave, health care, and other benefits during the 1-year period before the date on which the loan is made. All right. And how does that relate to the $10 million? The lesser of. Okay, we're just going to copy this whole nugget right here. Hopefully it's accurate. We'll see if it appears elsewhere. Kind of like the language on it. Nice and simple. Loans are given up to the maximum of the lesser of $10 million or 2.5 times the average monthly payroll cost. So this is kind of for the big fish, if you will, because if you have a small business and you have a few employees, you may not have a tremendous amount of your expenses being paid for payroll. So this may dramatically limit the amount that you get under this thing. That's something to consider. Obviously, it looks like big companies are going to benefit a little bit more from this, or medium size, I should say. I'm sure there are provisions there that won't allow huge Apple-like, Microsoft-like companies from taking advantage of this, or maybe there are. I don't know. But the point is that this may significantly limit the application or the benefit of Paycheck Protection Program for many self-employed small business. It is anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. So again, they don't want you to pay for software and pay for other ancillary business expenses. This looks to be specifically geared for maintaining employment, avoiding mass unemployment. So got to make sure we understand that and keep that in mind. Make sure you guys see that. Okay, moving along. We're learning. All right, the maximum interest rate under this program is 1%. Again, that changed recently. Let's make sure we have that. Okay. And the loan term is 2 years. Okay, got that. No personal guarantee or collateral is required. This collateral, personal guarantee. All right, we got all that. We're moving and grooving, folks. Payments are deferred for 6 months. This is where I thought the CNBC article was off. Didn't make any sense. Let's take a look. Let's see. Was it here? No. Was it this one? Okay. There was one article here where they were referencing the fact that it's 1 month, and now I can't find it. Maybe it's in this article. Okay. It says here, on the EIDLs, the first month's payment are deferred a full year from the date of the promissory note. And now let's go down here. It talks about paycheck protection. Payments are deferred for 6 months. Okay, so let's see how that plays out in terms of the paycheck protection side. Payments are deferred for 6 months, apparently. Okay. Part of this loan may be forgiven, not counted as income if it's spent during the first 8 weeks on operating costs. So again, we're learning a little bit more about the 8-week requirement. So we'll want to delve into that a little bit more, make sure we understand. So loans are forgiven when the proceeds are used for any of these costs. Payroll costs exceeding prorate amounts for individuals with compensation greater than $100,000. So they want to make sure they focus on that first $100,000. It sounds like rent pursuant to a lease enforced before February 15, 2020. Electricity, gas, water, transportation, telephone, internet access expenses, which began before February 15, 2020, and group insurance premiums and other healthcare costs. Now, we're talking about the Paycheck Protection Program here. And let's make sure that we have this information. Most mortgage utility costs over the 8-week period after the loan is made. All right. Okay, so they don't want individuals making, $800,000 a year to start getting humongous benefits from this. So it says here, be careful here. In order for the amounts to be forgiven, you must maintain the same average number of employees for the first 8-week period beginning on the origination date of the loan as you did from February 15, 2019 to June 30th, 2019, or January 1st, 2020 until February 15th, 2020. If you don't meet this requirement, the amount forgiven is reduced. You incur additional reductions if you cut compensation for employees who make under $100,000 by more than 25% as compared to the most recent quarter. That's very, very complicated. So we're not going to delve, I think, that deeply into this, but just know that in terms of this payroll protection program, they're really focusing on making sure that it's paid for that purpose. They don't want these amounts to be reallocated or abused in terms of what they're applied to. So that's interesting. Okay. And this is for 8 weeks they're talking about. This is not for months and months and months. They really want to get businesses out of what's currently happening and get them back on track. And if you abide by the rules, you meet all the requirements, the idea is this loan or a portion thereof is forgiven. So they're essentially giving you a grant for the portion of those eligible expenses depending on how they're used. And again, it could be more favorable than a loan if that's the situation. But even if it is a loan, the maximum interest rate is 1%. So it's not going to break the bank that badly. So let's keep learning. There's a frequently asked questions here on the Forbes website. Let me throw that in the chat for you guys. And let's see if there are some good nuggets here for us. And again, this was updated on April 1st, published on April 1st, 2020. You can see here that they had to update it. We already know why. Now, it says, can I get these loans and unemployment? The CARES Act not only provides relief for small business owners, but also the self-employed, independent contractors, and part-time workers. That initially sounded like double dipping to me, but as a colleague pointed out, it could make sense if your unemployment is covering personal expenses, while your EIDL and or PPP is covering other operating expenses. For example, if you're a restaurant owner, you have to pay for mortgage, paid leave, and supply chain disruptions, while we all wait out stay-at-home orders. But you also have to buy groceries and pay your home utility bills. If you can only get a loan to cover business expenses, you may still need unemployment benefits to pay your personal expenses. The issue is how the unemployment benefits would look at that, because that may affect your eligibility, and that's what they're saying here. Keep in mind the details for unemployment benefits, eligibility rules, benefit amounts, lengths of payments, etc. vary from state to state. In Illinois, for instance, to maintain your eligibility for unemployment, you must be able to work. You have to be able to accept the job, and you have to be looking for work. If the additional loan funds allow you to keep running your business, it may be hard to demonstrate that you're out of work. Interesting. So there may be some things to watch out for if you're getting unemployment benefits and also you're looking for some of these relief provisions to work in your favor, because it can be looked at as a bit of double dipping, and if you have your own business with unemployment, that may be a problem. Meaning if you have your own business and you're also collecting unemployment benefits. The other question here, we're talking about these things side by side. We're kind of comparing them, but a valid thing to ask is whether you can get both an EIDL, which is the Economic Injury Disaster Loan, and the Paycheck Protection Program loan, PPP. It says yes, you can get both loans, but the key is to use the money to cover different expenses. Okay. There's a section within the Act, Section 1102. It says the borrower has to certify that the eligible recipient has not received amounts under the subsection for the same purpose and duplicative amounts. So here's a good breakdown of what specifically each of these provisions is supposed to cover. As a reminder, EIDLs can be used to cover paid sick leave to employees unable to work due to the direct effect of COVID-19. Let's look down here in the PPP section. Is that there? Not quite. Okay. Maintaining payroll. Let's look at PPP. It says payroll costs. All right. EIDL, increased costs due to supply chain disruption. On the PPP side, I don't see that. So that may be something that's one-sided in terms of the application. Rent or mortgage payments. You have interest on mortgage obligations, rent under lease agreements in force before February 15, 2020. A lot of good detail here. We're going to throw this into the spreadsheet. And we have on the EIDL side, repayment obligations that cannot be met due to revenue loss. And I don't see that on the PPP side. Now, that doesn't mean it's not applicable, but it's not listed there in this very article. So we're going to note that. Interesting. So there are nuances in terms of the application of all this goodness. Let's call this, allowable expenses. And now we're referring to EIDL. All right. Okay. And on the PPP side, we have this goodness. This is very helpful. Now, let's make this pretty. Okay. just messed that up. But let's see if we can avoid disaster. All right, there we go. My Excel nerdiness is finally paying off. And here, let's do the same shebang. All right, we're good. By the way, guys, drop me a comment if you have any fun weekend plans, given the limitations that we have to deal with under current circumstances. Okay. This is good. So allowable expenses, we see that there are some differences. Let me try to make this a little bit more visible. But that is a fairly apples to apples comparison of what these provisions may be used for. Now, the question is, are these items also applicable on the EIDL grant side? We'll have to round out our understanding of that. To sum it up, it says if you're using EIDL to cover payroll expenses, you can't get a PPP to cover payroll for the length of the forgiveness period, which is 8 weeks from when the loan is due. you would have to use the EIDL for differing operating expenses or payroll for a different period. This will also go for other state or local assistance. That being said, you don't have to have both. If you're already gotten an EDL for payroll purposes, but just want the PPP loan, you can refinance the loan into a PPP. Any amount that was given to you as a grant under the EIDL will reduce the amount forgiven under the Paycheck Protection Program. Trying to digest that a little bit. So let's say you're getting an economic injury disaster loan to cover payroll. You don't get PPP to cover payroll for the length of the forgiveness period. So EIDL, we're paying payroll. You can't get a PPP loan to cover payroll for the length of the forgiveness period. So you use EIDL, it sounds like, for a portion of that time. And then you would then use the PPP portion for the rest of the period within the 8 weeks, it looks like. And if you already got an EIDL, let's say you fill out the application, you got the loan, and you want to then have the PPP instead, possibly because the amount might be larger under that loan, you can refinance the EIDL into a PPP. Any amount that was given to you as a grant under the EIDL will reduce the amount forgiven under PPP. I think that makes sense. All right, let's look at another question. It says, I work by myself and pay contractors. Do I still have payroll? That is interesting because when you think of payroll traditionally, you're looking at salary, wages, W-2s that you send to employees. So if you're self-employed, let's say you have a single member LLC even, and you pay contractors, do you have payroll for purposes of the Payroll Protection Program? And let's find out. It says many sole proprietors or independent contractors have wondered what counts as payroll if they don't have employees. Section 1102 expands the definition of payroll costs to include the sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission, income, net earnings for self-employment, or similar compensation that is not more than $100,000. Trying to wrap my mind around that part. Now, let's parse this. The definition of payroll costs include the sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission, net earnings from self-employment, or similar compensation that is not more than $100,000. So the way I'm interpreting that is that if you have net earnings for self-employment, that's going to be a factor here. But does depreciation play into that? Because I know a lot of self-employed individuals, they don't calculate depreciation on their financials. That happens on the tax returns, right? The CPA typically takes care of that at the end of the year. So I think a little more clarification will be necessary as far as whether we're talking about cash compensation. Is it based on the tax return amounts? How does that work? All right. And then in the most recent guidance, the SBA clarified that while income of sole proprietors and independent contractors count as payroll, payments to independent contractors do not count. Okay. Independent contractors have the ability to apply for a PPP loan on their own, so they do not count for purposes of a borrower's PPP loan calculation. All right. So basically, if you're a sole proprietor and you work with other independent contractors who work for you, then they can get a loan on their own, but you can't get a loan based on the payments you make to independent contractors because that doesn't count. They're their own business owner. They're not your employees. So it's not your payroll, so to speak, in that respect. All right. Getting a better idea here. Now we're getting into the details. I told you guys we're gonna delve. We've been delving. So next question is, what is this 8-week formula everybody keeps talking about? This is the formula to figure out if your loan forgiveness under PPP will be reduced. And apparently there's some kind of illustration from the U.S. Chamber of Commerce. We'll take a look at that in a second. You take your payroll costs, multiply them by a fraction. The top half of the fraction has the average number of full-time employees per month for the 8 weeks beginning on loan origination. The bottom half has either the average number of full-time employees per month from February 19th, 2019 to June 30th, 2019, or the average number of full-time employees per month from January 1st, 2020 to February 29th, 2020. Seasonal employees have a different time period. So that's a lot. That's probably more than we're going to get into it right now, but let's take a look at that Chamber of Commerce document that they're referring to here. And that's this beautiful beast. Updated April 1st, 2020. So what do we know about that? We know that that's not really the most recent guidance, but let's still take a look. All right. It asks here, how much can I borrow? Loans can be up to 2.5 times, the borrower's average monthly payroll costs not to exceed $10 million. We already knew that in our spreadsheet. Loans are given up to a maximum of the lesser of $10 million or 2.5 times average monthly payroll. So how do I calculate my average monthly payroll costs? This is, again, PPP, Payroll Protection Program. It says that you take the sum of included payroll costs minus the sum of excluded payroll costs. Okay, thanks. For included payroll costs, we have here for employers the sum of payments of any compensation with regard to employees that is a salary, wage, commission, or similar compensation. Cash tip or equivalent, payment for vacation, parental, family, medical, or sick leave, allowance for dismissal or separation. Let me make it so you guys can see this more easily. Okay. All right. So allowance for dismissal or separation, payment required for the provision of group health care benefits, payment of any retirement benefit, and payment of state and local tax assessed on compensation of the employee. So those are included payroll costs for PPP. There you go. So you might ask, okay, what if I'm self-employed? Let's take a look. For sole proprietors, independent contractors, and self-employed individuals, the sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage, commission, income, net earnings for self-employment, or similar compensation that is in an amount no more than $100,000 in 1 year. So as I'm reading this more, it's starting to gel a bit. So I think what they're saying there is if you're a sole proprietor and you're getting some commissions, you're getting some income, net earnings from self-employment, I think, refers to possibly pass-through income. So if you're a partner in a partnership, now I'm straying from the verbiage here. I'm just using my imagination. Don't quote me on this. But if you're a partner in a partnership, you're getting flow-through income. It's subject to self-employment tax. That may be what this net earnings from self-employment is referring to, because the language reminds me of what you have on a Schedule K1 from a partnership. Let's take a look at what that looks like. Now, I may just be delirious because it's 1 a.m. right now, but let's just see. Okay, so right here on the Schedule K1 for partnerships, 1065, we see that on line 14, there is self-employment earnings. That may be what they're referring to, may not be. It's hard to tell, but I'm trying to parse this otherwise and having a little bit of trouble there. Let's go back to the document we had. All right, if you guys are still with me, hit that like button, hit that subscribe button. I mean, you're warriors for sticking through this far, but we're pushing through. We understand this thing a lot better now. I'm feeling good. You're feeling good. It's all good. All right, back to this document here. This is from the U.S. Chamber of Commerce. Again, let's read this one more time. The sum of payments of any compensation to or income of a sole proprietor or independent contractor that is a wage. How can you be an independent contractor and get a wage? Commission, income, net earnings from self-employment, or similar compensation that is an amount that is not more than $100,000 a year as prorated for the covered period. All right, so they're putting a cap. It sounds like it's the $100,000. It doesn't sound like you're excluded if your net earnings from self-employment are more than $100,000, but it's just saying you focus on that $100,000 for purposes of determining what your included payroll costs are as a sole proprietor, independent contractor, or self-employed individual. I don't know why they're separating sole proprietors from self-employed individuals, but that may be something that I have yet to learn about this. Now let's look at excluded payroll costs, because we see that we have to take the included, subtract the excluded, so that may be important. Well, I'm sure it is, but let's understand this. So excluded payroll costs, first is compensation of an individual employee in excess of an annual salary of $100,000 as prorated for the period February 15th to June 30th, 2020. Okay, so they're just looking at a small window there, it sounds like. And this is an annual salary as prorated for the period from February 15th to June 30th, 2020. Payroll taxes, railroad retirement taxes, and income taxes. They're excluded payroll costs. Okay. All right. It's interesting because if you're an employer and you're paying $100,000 to an employee, let's not use that number. We're going to confuse it. Let's say you pay $10,000 to an employee. You're also going to need to pay payroll taxes on that. And I'm kind of surprised that that's an excluded payroll cost for these purposes, and that they're just focusing maybe on the employee salary specifically, not of the employer portion of those payroll costs being Medicare and Social Security and things like that. So it is what it is. Okay. Other excluded payroll costs, any compensation of an employee whose principal place of business of residence is outside of the United States. Okay, so they have to be U.S. based in terms of where they reside. And qualified sick leave wages for which a credit is applicable under Section 7001 of the Families First Coronavirus Response Act. Okay. So they don't want you, I guess, to double dip. That's what this provision is saying. Okay. All right. The other thing to note about this United States Chamber of Commerce publication is that it also references the 0.5% rate for these loans, being the Payroll Protection Program, but we know that this has been increased to 1%. But they do have that the loan is due in 2 years. That is part of the revised provision. So they had half of it, but not all of it. So that may be just an error in putting together this document. It may be that the changes were done kind of piecemeal. All right. So in terms of rounding out our understanding, I think definitely we've made some progress here. Let's just do an overview. Obviously, this is not meant to be a dissertation on this program, but certainly we want some insights. To recap, up to $10,000 EIDL grant. The amount appropriated for this whole EIDL situation is $10 billion at a maximum. The big kahuna, Paycheck Protection Program, $349 billion. So $10 billion, $349 billion. The maximum amount that you can get under each one of these categories, under the EIDL grant, The maximum amount is $10,000. We have yet to figure out exactly how that's calculated or what that's based on, but it's available. Now, the economic injury disaster loans, that's up to $2 million. All right. And we've yet to understand what that's based on. So we're going to delve a little bit deeper, round out our understanding. And actually, let's do that right now, because there's yet another document I found, which is, bear with me here. All right. This is put out by the SBA. And I'm getting ready to sneeze, so excuse me. All right. Let's keep rocking and rolling. I haven't left the house today, so guys, don't worry about me. I haven't been washing my hands. Okay, so this is the COVID-19 relief for small business. And this is a nice 37-page PowerPoint document, which looks like it's going to be fun. And let's see how much of this we already know. Let's see how much of this we can corroborate based on our understanding. So the SBA's working capital disaster loans, funds come directly from the Treasury, no cost to apply, no obligation to take the loan if offered. Maximum unsecured loan amount is $25,000, automatically deferred for 12 months. An advance of up to $10,000 is available. So in terms of the payment deferral, looks like they're talking about up to automatically deferred for 12 months. Okay. All right. So these are the terms here. And how much can I borrow? It says $2 million. We have that. Interest rates. We have those here, 3.75 for small businesses, 2.75 for nonprofits. Terms up to 30 years. All right, so now we can get rid of this. So in the other document, it said that it's 30 years. Now we see from the SBA, it's up to 30 years. Eligibility based on the size, type of business, and financial resources. Crucial bit of information here. Let's see if I can highlight this bad boy. No, of course not. That would be too easy. Anyway, we're going to write that because it is extremely important. Let's see if we have qualifications. Okay. Payment deferral, maximum maturity. Now, what are we going to call this here? Eligibility terms. Eligibility based on size, type of business, and financial resources. Size, type of business, and financial resources. It's getting late, guys. Typing is hard. Okay. And I've gone almost 2 hours without saying the words, are you down with PPP? Yeah, you know me. I had to. I'm sorry. I had to. All right. Eligibility terms. Very important. So economic injury disaster loans, because we didn't know what these amounts are based on up until now. Funny how you can read all those articles and still not have any clarity on this. It's kind of irritating. But looking at this, now we know. So economic injury disaster loans, let's absorb that. Based on the size, type of business, and financial resources. Coffee time. All right. How can I use the loan funds? Let's see if we have this. Fixed rents, fixed debts, rent, etc. I like how they just say rent, etc. next to fixed debts. I don't know how those are related, but payroll, accounts payable, some bills that could have been paid had the disaster not occurred. Okay, let's see if we have that. Okay. Now, loan forgiveness is one thing, but how can I use the loan funds is a whole different thing. Okay, so we have forgiveness terms. They're talking about the loan terms themselves, and this could be up to 30 years. You got the interest rates here, not the lowest interest rates ever, but again, much more favorable than you'd get from a bank, funny enough. And again, these are loans that you apply directly to the SBA. You don't go through the bank. Eligibility. We touched on this. We didn't put it in the spreadsheet, but let's take a look because this should spell it out very clearly. Small businesses under 500 employees, sole proprietors under 500 employees, cooperatives under 500 employees, ESOPs, same requirement, and tribal small business. All right, we're not going to get into too many details. Ineligibility. This is for EIDL. Illegal activity, as defined by federal guidelines. Again, the marijuana businesses might have some trouble here. Worth looking into, doing some analysis. You have a principal with a 50% plus more than 60 days delinquent on child support. So there's a connection to child support there. And an agricultural enterprise, example farm, other than an aquaculture enterprise, agricultural cooperative, or nursery. I know some of those are English words. That's all I can tell you about that. But let's keep going. Again, Congress people love to put this in. Displays of a prurient sexual nature, directly or indirectly, whatever. More than a third of gross annual revenue from legal gambling activities. So even if your other 2/3 is from illegal gambling activities, the legal part is what's going to get you. Okay? Is in the business of lobbying. All right? And is a state, local, or municipal government entity and cannot be a member of Congress. Fair enough. Primary criteria for approval of the EIDL: acceptable credit history, ability to repay the SBA loan. Let's see if we have that information. Okay, so self-certification and credit score. We have that. But now let's put this in. Okay. All right. Rounding out information. Isn't it crazy how we can read all those articles and still not have a comprehensive all-around understanding? It's a really complicated provision. Ineligible uses of the loan. You can't use it to pay dividends, bonuses, disbursements to owners unless for performance of services. Okay. Repayment of stockholder or principal loans. There are exceptions to that. Repair or replacement of physical damages. It's not that kind of disaster. Refinancing long-term debt. Okay, it's understandable. They want to maintain the economy, keep the economy going. They don't want this to be used for other purposes. Let's move on. Here's the application. I did a whole nother video on the streamlined application. Check that out. It's pretty straightforward. It's easier than you think it is, that I can tell you. Very straightforward. And they basically ask for gross revenues, cost of goods sold, lost rents if you're in the real estate business, cost of operating expenses for nonprofits, other reimbursements that you will receive if you have, let's say, business interruption insurance coming your way, and the number of employees. And this is for the 12 months prior to January 31st, 2020. That's the information, for the most part, that they require for this streamlined SBA loan. Very straightforward. And if you want to apply for that $10,000, up to $10,000 EIDL advance, then here's where you would do that. Now, this is new that I'm seeing. I just noticed this now. Up to $10,000, depending on the number of employees. So that's the first place I'm seeing that. But that may be another insight into how they're calculating or allocating these amounts, because I believe right now we don't know that much about how they're determining this. The amount, rather. And what's likely to be requested by the loan processor is the SBA loan application, personal financial statement, schedule of liabilities, and tax information through Form 4506T, which allows them to get information from the IRS on your behalf. And what they may request is federal income tax returns for principals, general partners, or managing partners and affiliates for 3 years. The most recent federal income tax return If that's not been filed, a year-end profit and loss statement and balance sheet for that tax year, a current year-to-date profit and loss statement, and additional filing requirements. So they may reach out to you and say, hey, okay, we need these additional details before we can process the application. Additional details. If more funds are needed, applicants can submit supporting documents and a request for an increase. If less funds are needed, applicants can request a reduction in loan amount. If the loan request is denied, the applicant will be given up to 6 months in which to provide new information and submit a written request for reconsideration. Okay, so EIDL, frequently asked questions. How long will it take to know if I'm approved for the loan? We're processing them as soon as possible. Figured. Let's see here. I think that pretty much covers it. Now, it asks, how does a business define an impact or a loss for this? Is there a percentage, dollar amount? What are the parameters? It says a business needs to define its loss in comparison to its 2019 operations or financials. Losses will be compared to the effective incident period starting on January 31st, 2020. Just a loss needs to be reported. There is no threshold of a percentage or dollar amount, which is really mysterious because how do you attribute a loss to this coronavirus thing versus just seasonality, normal business operations? I don't quite know, but it's in the FAQ from the SBA, so it's important to consider. So now let's jump to the Paycheck Protection Program, because this whole time we've been talking about this bad boy right here with regard to this document. So let's see how much of this we already know and how much of it we may need to relearn. The Paycheck Protection Program provides small businesses with funds to pay up to 8 weeks of payroll costs. We've seen that before. Funds can be used to pay interest on mortgage interest, rent, and utilities, and the entire loan amount may be forgiven. Up to $10 million. Must be a small business. Okay. Payroll costs, we see that up to 75% of this, or at least 75% of this has to be payroll costs over 8 weeks for the Payroll Protection Program. That includes salaries, wages, commissions, and tips. And I believe we already went over a lot of this, so we'll keep it at that. But capped at $100,000, that's a key point. Other eligible costs: interest on mortgage payments, rent under lease obligations, and utilities. But mostly, it has to be for the payroll, and then you need to be obligated before February 15th. Key dates. A lot of things are recurring now for us, right? Because now we're getting a little bit more educated with this, a little bit more familiar. And lenders will verify that your business was in operation on February 15th, your business had employees, and they will apparently verify average monthly payroll costs. All right, other requirements. Let's look at our spreadsheet. Collateral required? No. Personal guarantee? No. SBA fees or agent fees? No. All right, we have that here. Okay. And the forgiveness parameters: loan proceeds covered approved costs. The employee numbers are maintained. Compensation levels are maintained. So that is paycheck protection defined, basically. All right. And finally, to request loan forgiveness under PPP, you submit a written request to your lender. Your request should include documents verifying full-time equivalent employees, employee pay rates, payments on eligible mortgage, payments on lease, on utilities, and lender apparently has 60 days to reply because remember, with PPP, you're going through the banks. If your loan is not forgiven, you have a 2-year repayment term. Again, 0.5% interest rate, no longer accurate. It's 1% now. Who knows what it's going to be tomorrow? 6 months deferral. Do we have that? All right, let's take a look here. Let's expand this bad boy. Payment deferral. Okay, we have that. Payments are deferred for 6 months. Interest will accrue during the 6-month period. Okay. It's at 1%. It's not the end of the world. And then there are no prepayment penalties. No prepayment penalties. Okay. All right. Now, again, pretty straightforward ineligibility rules. And how much can I request? 2 months of average payroll cost plus 25%. So that's 2.5. All right. So basically, if your average 2-week payroll cost is $8,000, you add 25%. Okay, I think this is wrong. So I think they mean 2-month average payroll cost equals $8,000. You add 25%, and that is your maximum loan amount under PPP. So let's do an actual calculation, not this thing. So let's say you're paying $10,000, or let's align it. So $8,000 you're paying for 2 months of average payroll cost. So that would mean your average payroll cost per month is $4,000 times 2 times 1.25, $10,000. That's the loan amount. So that's the calculation you go through on a simpler basis here. So you take the 2 months of average payroll cost. Start with 1 month, $4,000, let's say, times 2 times 1.25. That's your maximum loan amount under PPP. And we already have that on our spreadsheet here. And again, you have the other limitation of $10 million. Most of my clients, that's not going to apply, but that's what it is. And how do I apply? You contact your local bank and ask if they're participating and so forth. All right. So, guys, we're almost at the 2-hour mark with this. Hit that like button. Hit that subscribe button. There's going to be more stuff. You know there's going to be more stuff. But now we want to switch gears a little bit and move on to phase 3 of this bad boy. And this is what I've been advertising from the beginning. This is where it gets kind of juicy. We get out of this analysis situation. And as you can see, we learned a fair bit here. Just keeping it real, we have a good idea of what all of this relates to. Now, why don't we have allowable expenses for the EIDL grant? It's kind of bugging me. Let's fill that gap there. So EIDLs can cover all these costs, but let's go back to the language of the bill, because there seemed to be some clarity there with regard to the emergency grant uses of funds. Let's see if this matches. So here's what it is in the bill. Here's what we have on our spreadsheet for EIDL in general. And if they're the same, then that would make sense. I mean, they're part of the same provision, so wouldn't really blow my mind too much. Let me make it so you guys can see all this. Trying not to sing any popular songs. The last thing I need is things that get copyright claimed last minute. Anyway, so we have providing sick leave to employees, maintaining payroll costs, okay, increasing costs due to, it's the same. All right, so this $10,000, so we could just copy and paste this right here. So EIDL appears to have similar rules with regard to what expenses it can be used for. So, quite frankly, this allowable expenses area is going to be the same for these two. And it's going to vary slightly for the Paycheck Protection Program here. And these are important nuances, because when it comes time to apply for forgiveness and this and that, then it's going to matter. All right, so let's try to fill in some of these gaps here. So payment deferral on an EIDL grant, the idea is that it would be forgiven, I would imagine. So intended to be forgiven. So in terms of payment deferral, it shouldn't really apply. Automatically deferred for 12 months. Payments are deferred for 6 months. Okay. All right. All right. That's the idea there. Now, again, I'm not sure what happens with the amounts that you don't use for the proper expenses. Do those turn into loans? Do you have to just repay it? I'm not quite sure. Does it turn into an EIDL disaster loan? That's a question I don't know at this point, unfortunately. So in terms of eligibility, so we're talking about size, type of business, financial resources. Let's see what the eligibility parameters are for the emergency grant. Let's see if we can find some information on this. Doing some live Googling right here on the Efros Financial Show. Okay. Now, this is Jackie Rosen, U.S. Senator for Nevada. I don't even know why we're looking at this, but let's see if there's any clarity here. Who's eligible? We've got that. See if we can find some information on the SBA website. It's kind of the last place I'd look, unfortunately, just given my experience with it. Will be made available following a successful application. So, still don't have eligibility. Here we go. Program is for any small business with less than 500 employees. And let's see, grant calculation. I still don't quite understand how they're going to arrive at that. U.S. Chamber of Commerce, loan parameters, emergency grant. Within 3 days of application, it's supposed to arrive. That's another funny topic there. All right, so in terms of eligibility, this is still up in the air a little bit. I want to round that out, but given all the information we've went through, I still need to get a better grasp at this. I might run through some of these open items in a different video just to round out our understanding. But I think based on where we started, we're definitely in a different place. That's for sure. All right. So in terms of forgiveness for the economic injury disaster loans, I don't believe that these are going to be forgiven. It's just the grants that's used for eligible purposes. Now, uses of funds are specifically down here. Let's connect all this good stuff. All right. So let me just give you guys a view here of all of this goodness. Hopefully this all shows up. But this is kind of where we are. If you wanted an apples-to-apples comparison of these different parameters, this may very well be a good starting point to understand this, or at least have a discussion about it. But let's make sure that we can see all this. All right, so feel free to grab a screenshot or something like that. I'm going to figure out how to get this distributed in an easy to digest manner. Let me make sure that you guys can see all of this. All right. So we see here that in terms of the overall amount, the total maximum is definitely highest under PPP, but certainly EIDL is no slouch in this regard. The allowable expenses are similar in some ways. Okay, now you can see it. Similar in some ways, but also important differences to take into account. So make sure that you really know what you're spending the money on, because you can't double dip. And if you're spending money from one of the programs on particular expenses, you don't want to then allocate those same expenses to another another program, because that would essentially constitute double dipping. They want you to use funds from EIDL for one purpose, funds from PPP for a different purpose, not double dip, and consider the same expenses for both. Method of application, we have the SBA website for the EIDL side of things. For the Paycheck Protection Program, you're going to the SBA lenders. So these are the banks. Now, payroll deferral, the payment deferral rather, the $10,000 EIDL grant, or up to $10,000, it's intended to be forgiven, not really applicable. Automatically deferred for 12 months on the EIDL side. So you get the loan, you're not making the payments on that. And that's up to 30 years in terms of the maximum term. On the PPP side, you're looking at payments being deferred up to for 6 months. So still, in terms of cash flow, has some benefit there. Now, we still have some gaps to fill here in terms of eligibility. I think this may be still a question mark. Let's highlight this and let's see if we can get back to this in a different video for you. And the Paycheck Protection Program, again, let's I think reference this situation. Loans will be forgiven. Where can I apply? What can I use the loans for? Payroll costs, paid sick leave. When can my loan be forgiven? Okay, so I have to understand that a bit more. Now, it may be that the eligibility is just based on the fact that you were affected by this thing, but it still remains unclear to me on this side what the terms are. Maximum maturity term, EIDL, up to 30 years. Paycheck Protection Program, 2 years. It was floated around as being 10 years, or up to 10 years, but they changed it to 2. The prepayment penalties or fees, we know that on the PPP side, none of that's applicable. In terms of the interest rates, it's 3.75 for small businesses on the EIDL side, 2.75 for nonprofits. And on the PPP side, it's 1%, changed from the 0.5% that was floating around a little while ago. But per the terms of the legislation, it's not more than 4%. So there's some flexibility here that they may come back and increase it. Who knows? In terms of verification, they talked about on the EIDL side, you're essentially looking at credit worthiness and so forth. Some self-certification happening as well on the grant side of things. Does that also apply to EIDL? I believe it does. You're basically self-certifying, but they also look at your credit. And on the payroll protection side, I can imagine a lot more documentation being necessary there because now the banks are involved and that whole thing. In terms of the forgiveness, in terms of the grant, that's the idea, but you have to pay it for the appropriate expenses. The economic injury disaster loans are not forgivable, and the Paycheck Protection Program, if they're used to cover the appropriate costs and mortgage interest, rent, utility costs over 8-week period after the loan is made, again, more than 75% or at least 75% has to be payroll. The rest can be up to 25%, is my understanding. That can be forgiven if it's spent on the right things. Again, they're trying to protect the paychecks. Keep that in mind when you're thinking about PPP always. Forgiveness details, and the loan forgiveness will be provided for the sum of the documented payroll costs, covered mortgage interest payments. Doesn't look like they're covering the principal. Covered rent payments, covered utilities, and due to likely high subscription, it is anticipated that not more than 25% of the forgiven amount may be for non-payroll costs. So they're really trying to hone in on that. And the uses of the funds, particularly on the EIDL grant side, they want you to focus on, I believe we're duplicating amounts here, paid sick leave, maintaining payroll. All right, so we're duplicating this. So let's get this out of here. Now, there are a few areas here that we need to understand a little bit further. I'm going to highlight those. Maybe we'll revisit those. But if you've stuck around this long, like the video, leave a comment, subscribe to the channel, let me know you're out there. I love reading your comments. Now that we've learned a fair bit about these provisions, the question is, and this is the phase 3 that I was talking about, how's this all playing out in the real world? What does this all look like when businesses are applying for these loans? What experience are they having? Are they seeing the funds, or is this all sorts of fugazi? Now, we have to get an extremely big salt granule for this, okay? We need a huge grain of salt because I'm going to read some experiences that people are having per Reddit website. So specifically, this is the small business subreddit. Again, huge grain of salt. Haven't verified any of this. There's no way to verify this, but this is some of the experiences that people are having in terms of actually getting or trying to get these loans. Now, if you're offended by rough language, look away, because we are going to delve into Reddit, and who knows what's going to be here. And a lot of unhappy campers here on the small business subreddit. Here's the link for you if you guys want to go. And by the way, I use the old Reddit, which means you put OLD instead of www in the URL, and you will experience what Reddit is supposed to be, not the disaster that it is if you don't do that. So here's an experience of someone. No verification, big grain of salt, but let's read. It says, a seemingly lucid answer from SBA on EIDL. Spent 2 hours on hold. Already a great experience. Very nice lady answered. She stated that she had worked for SBA for several years. She asked for my last name and asked if I had a 20 series, 33 series, or 36 series application number. Again, EIDL, you can apply on the website for Small Business Administration, and then once you go through that process, I already made a video about this, you get a verification number or confirmation number, and that's what they're referring to here. So she asked what series application number. I had a 20 series, the older long form. The 33 series is the new streamlined form. She was able to find my file by the 20 series number and said it was complete and headed to a case manager. According to her, that means my credit, docs, and financials were all in order. Yay. She said the case manager would be able to access the 33 series and either delete, merge, or process separately in the event that I had two businesses. So the 20 series is the older application that was put out there. The newer one is the 33 series streamlined application, and you can tell by the beginning number, it looks like, of the application number or confirmation number. She said they are working through the applications, beginning with those who started with the long form to process out advances. That's the up to $10,000 amounts. She said no advances have been sent yet because those who have done the long form have done everything that the people only using the streamlined app will have to do once to complete the process. Interesting. So essentially what this person is saying, again, not verified, but they're making the case that the old application was complete in that if you went through it, you did everything you needed to do. But then if you went through the streamlined application, then you essentially have more work to do. So it's incomplete by its nature. It doesn't allow you to provide all those additional documents and information. It just says submitted. It says the long form will get the advance within 3 days of speaking to a case manager. Then the rest will be sent via standard underwriting and process up to 30 days. Once those are done, then the streamlined people start getting advances and doing the long form paperwork for standard underwriting. So here's what I get from this is the gist. Advances are 3 days from the case manager review. Review queue is 1, completed long form with documents submitted. 2, semi-complete long form that might be missing docs. And 3, streamlined applicants. So it's interesting that you may look at the fact that they had a long form and then the streamlined form as sort of advantageous towards businesses because you think that they want to make it easier. They want to make the process more straightforward so that they could just get the money out there. But what I'm reading when I see this is that they essentially said, you know what? Let's try to slow down the stream of applications. Let's throw a nice roadblock into it. Let's essentially stop the ability to submit a complete application. And instead, let's put the streamlined app out, which is going to require additional follow-up and reaching out for those additional documents, which adds another roadblock into getting the money out. So when I first saw that there was a streamlined application, I got a little excited. I got a little bit optimistic about the prospect of, hey, maybe this really is streamlined. Maybe the whole goal is to get the money out there quickly. But it looks like it may be completely the other way around in that they said, oh, well, we're getting a lot of action on this thing. Let's slow it down. Let's throw some roadblocks in there and not have this all come in an avalanche. Interesting. Let's continue on. This person says the circus continues, 5 calls, 5 different responses. This is calling the SBA. Call 1, you have to email your application number to disastercustomerservice.sba@sba.gov. I will get a response from my loan officer by email. I call BS and call again. Call 2. You will receive a call from a loan office 2 or 3 weeks after your original application. I ask him when it was, as I have the app number, and he says they don't go by app number, and he's unable to pull it up. Okay, I give up. Next. Call number 3. The lady tells me that all applications prior to March 31st are not valid, and if I applied before, then I'll need to reapply. I don't even have the patience to argue with the absurdity of that response. Call number 4. You wonder why there's such a long queue for calls at the SBA. This might be why. The SBA doesn't have any updates aside from my original received in review that I told her about. She said they get updates every day, but there is no further information available for her to give me. Call number 5. All right, so I had to escalate to get this call. Apparently it was tier 2, but it was the same phone prompt. So the whole process to get transferred to her 2 times was weird, but she was the only one who actually took my 2000 application number, which was for the original long form app. She said the short form app with 33 for me was not available in their system. Long story short, the date of the application was March 21st. Other than that, she seemed honest like the previous lady in stating that they have no way of knowing when the loan officer will contact me, but that my 2 applications will be combined and I'm indeed under review. All right, so she said there was definitely no 2 to 3 week timetable, and there was no need to reapply or nonsense about apps being thrown out or anything like that. Okay, so different experience there. And overall, on the banking side of things, it looks like the bank certainly had a say in what the paycheck protection loans are going to look like, because the interest rate seemed to go up overnight. Who benefits from that? I would think the banks, possibly. And we saw that the payment terms changed from up to 10 years, as was originally advertised, to now 2 years. The other thing is that, in terms of the banks, gotta love it. Gotta love it. Let's take a look at the bill again. Now, I'm just curious as far as what amounts the bankers might make on all this. And I wonder if it's stated in here. Let's take a look. I'm looking for some specific numbers. I did come across something that I did think was interesting. Percent. Okay. Here's an interesting part of the bill. And this is which provision? Paycheck Protection Program, the ones that go through the banks. Let's delve into this a little bit. So it says here, in general, the administrator shall reimburse a lender authorized to make a covered loan at a rate based on the balance of the financing outstanding at the time of disbursement of the covered loan of 5% of loans not more than $350,000, 3% for loans of more than $350,000 but less than $2 million, and 1% of loans not less than $2 million. So the only thing I have to say about that is, damn, it feels good to be a banker, because 5% on a $350,000 loan, what does that come out to? Not a bad payday, I would say. And in terms of the $2 million loan, $1%, you're getting 20 grand. Not a bad situation, but at the same time, this is what it looks like to me, is that the lender, being the bank, is getting this fee for giving this loan, processing it, really, says right here. At the same time, these same banks are saying, don't make it 0.5%, squeeze them harder. Make it 1%. And forget about the 10-year, up to 10-year repayment period. Make it 2 years. Let's really hammer them, right? But on the other side, they're making these fat fees for just processing a loan. Now, again, my understanding is they don't even have to take the risk. The government takes the risk. They back it. So what really looks like is happening here is that the banking buddies are getting their payolas, and everybody else is kind of getting screwed. The other thing is that you have these different banks that are refusing to accept loan applications from non-business customers, meaning that if you don't have a business bank account at Chase, they don't want to process your application. Bank of America, it says here, it looks like they are opening up to customers without credit cards, still not accessible for me. So let's click this link. And it says here that small business clients with a business lending and a business deposit relationship at Bank of America are eligible to apply for a paycheck protection loan through the bank. So what is this going to mean for those small business owners that have had relationships with banks that may not be processing SBA loans? Because they may go knock on Bank of America's door and say, hey, Bank of America, I'd love a small business loan under Paycheck Protection Program. And they'll be like, no, I'm sorry. You don't have a business lending and a business deposit relationship. A Bank of America can't help you. And what it says, a client's pre-existing lending relationship with us may include small business, commercial, or corporate credit cards, conventional business loan or lease, business lines of credit, business auto loans, practice solutions loans, trade and asset-based loans. It says small business owners who do not have a business relationship and business deposit relationship with us should contact their current business loan provider as soon as possible if they plan to apply for these loans. Again, going back to the whole idea, it's to provide cash to businesses quickly. But if, as a business, you're not able to even apply, if your bank is not providing these loans, if you can't go to a different bank, what are you supposed to do? Now, Chase, I also understand. Let's see, Chase, COVID, PPP loan. Let's see what their viewpoint is on this. So JP Morgan Chase said in a message on its website this week, as a result, Chase will most likely not be able to start accepting applications on Friday, April 3rd, as we had hoped. And they'll be reaching out to alert customers via email and on social media. And it's interesting that some of the banks, they're not going to accept applications from individuals who are not their current business clients, which I think will create a bottleneck in terms of getting these funds for businesses that need them. I'm going to research this a little bit more, and I'll probably get back to you guys with some updates in terms of how to go about this and how to possibly address it or get around it. But it doesn't seem like it's going to be helpful if banks all of a sudden start discriminating against their current big clients and everybody else gets left out in the dust. Should be interesting to find out. When the banks get involved, it's always good stuff. And I think that pretty much covers it. So it looks like definitely the financial sector has gotten their teeth around this thing. They've bumped up the interest rate. They've taken down the maximum payment term. Who knows what this thing is going to look like a few days from now. And the way it's playing out is a lot of, as you can see on Reddit there, it looks like a lot of business owners are having a lot of trouble in terms of getting the loans, being able to actually move forward with the application process, finding out what the status is. Banks are saying they aren't ready. There are a lot of complications with this whole thing, and hopefully this all gets resolved shortly so that the money can actually make it to these businesses that need it. So with that said, I think overall this is a good first round of research and understanding to get us familiar with all these different provisions and how this stuff is structured. But certainly we still have some gaps that I would love to address, possibly in a later video. But if you like this, if you got value out of this, if you learned something, hit that like button, hit that subscribe button, leave a comment. I love reading the comments. And ultimately, if you have questions, feel free to reach out. This is the middle of busy season in terms of taxes, so technically I should be doing some tax returns right now, but I did get a lot of questions on this from my clients. They're good questions, and I felt that it was necessary to address them by going through and having this learning process together. So hopefully this is visible on the screen for you guys, and you could see some of these applicable factors that may play into your decision process. As we could see, you can apply for either EIDL or PPP or both, but you can't use the funds for, you can't use the same expenses to justify both provisions, okay? You need to allocate it to where you're not double dipping so that you use one set of expenses for purposes of PPP, another set of expenses for EIDL. As long as they're both allowed for each respective program, you should be most likely okay. But again, make sure that you consult with legal counsel, make sure you consult with your financial professionals to make sure that for your particular situation, you don't run into any hurdles, you don't affect your unemployment benefits, or you don't have other adverse results from trying to get some help. Because at the end of the day, the idea is to improve, get better, and have a happier, more prosperous tomorrow. With that said, hopefully this was helpful. My voice is starting to go, and it's about 2 o'clock in the morning, so it's probably time to have more tea and make more videos. But with that said, hopefully this was helpful. Thanks for watching.